In 1929, the world learned a brutal lesson. Prosperity feels permanent until it isn't. One day, Wall Street was the center of the universe, an engine of endless growth. But the next, it was rubble. Fortunes that took lifetimes to build vanished overnight. Banks, the pillars of the community, locked their doors for good. And millions of ordinary people woke up to find that everything they had worked for was gone. Now, most people think of that as a one-time disaster, a black and white chapter from a history book. But here's the thing a lot of people miss. It was an isolated event. Because the underlying system that caused that collapse, it didn't just vanish into thin air. It evolved. It got smarter, faster, and much more invisible. You see, it's comfortable to believe that was ancient history. But what if it's actually a mirror, a reflection of what's happening right now in your life, in your wallet, in your city? Have you ever stopped and wondered why prices for everything just keep rising, no matter what? Why owning a home feels like an impossible dream for so many? Or why your debt seems to grow even when you're working harder than ever before? It's not just bad luck. It's not random chance. It's the echo of a machine built on risk, greed, and illusion. A machine that rewards a select few at the top, but systematically drains the rest of us. It's a system that promises security, but secretly thrives on instability, and it keeps you chasing a comfortable life, but is designed to never let you quite reach it. You might be thinking, that can't be true. Things are so much better now, but I invite you to look closer. The patterns are identical. The names on the buildings have changed. The technology has evolved beyond imagination. But the hunger, that same relentless hunger for profit, control, and illusion, it's still there, driving everything. So before we go any deeper into this, I have a quick question for you. Where are you watching this from, and what time is it right now? Drop it in the comments below. I love seeing how far these conversations travel around the globe. And if this message is already hitting something inside you, if it's making you question what's really happening around you, then stick around. Because what you're about to see will completely change the way you look at money, markets, and the very nature of power. Now let's rewind the clock to 1929. The world was high on a wave of pure euphoria. The roaring 20s were in full swing. Stocks were soaring to unbelievable heights. Ordinary people, teachers, farmers, factory workers, mechanics were piling into the stock market, buying shares like they were lottery tickets. But here's the critical twist. Most of them were buying with money they actually had. They were buying with money they borrowed. Back then they had a name for it, buying on margin. It was a fancy term for gambling on a market that only seemed to go one way up. You could put down just 10% of a stock's price and borrow the other 90% from a broker. As long as the stock price kept rising, you were a genius. But if it fell, you were wiped out. Newspapers ran headlines calling it the new era of permanent wealth. Politicians gave speeches declaring that the boom would never, ever end. And people believed them. Why wouldn't they? Because when you're winning, when everyone around you is getting rich, you don't want to believe the music could ever stop. Does any of that sound familiar? They said the old rules of economics didn't apply anymore. They said technology, the radio, the automobile was changing everything. Credit was cheap and easy to get. The future looked completely unstoppable. But lurking behind all that confidence, behind all the glamour and the jazzes, something incredibly dangerous was forming. A mountain of debt, stacking on top of more debt. And the only thing holding it all together was belief. Pure, unshakable belief that tomorrow would be better than today. In the years leading up to the Great Crash, this speculative fever went far beyond just stocks. The real estate market was exploding, particularly in places like Florida. Banks were lending money to almost anyone who could sign their name on a piece of paper, with very few questions asked. Companies were getting creative with their accounting, cooking their books to look far more profitable than they really were. This inflated their stock prices and drew in even more unsuspecting investors. And what about consumers? They were swept up in it too. For the first time, people were buying luxuries. They couldn't truly afford cars, radios, new appliances, all on installment plans. It was a culture completely addicted to optimism. But here's the timeless lesson. Optimism that is built on borrowed money always ends the same way. The party gets louder, the crowd gets wilder, and then in one shocking instant the lights go out, and everyone is left standing in the dark, wondering what just happened. The crash didn't happen in a vacuum. It was the final, deafening pop of a bubble that had been growing for years, and the fallout was catastrophic. It wasn't just wealthy investors who lost everything. The collapse rippled outward, hitting every corner of society. When the banks failed, they took the life savings of ordinary families with them. When businesses went bankrupt, millions of jobs disappeared. A decade of prosperity was erased in a matter of days, plunging the world into the Great Depression. But here's the crucial part that most people miss. The crash wasn't the cause of the Great Depression. It was the symptom. The real disease had been festering for years. It was a cocktail of too much debt, stagnant real wages for the average person, and a blind, Unshakable faith in a market that everyone believed could never fall. Sound familiar? It should. Let's fast forward to today. The names have changed, the technology has evolved, but the underlying story is strikingly similar. Back then, they followed the market on ticker tape and sent orders via telegrams. Today, we have sophisticated trading apps and live crypto charts on our phones. Back then, people borrowed heavily on margin to play the market. Now, we have a global system built on credit cards, massive mortgages, and government deficits that run into the trillions. The tools are different, but the addiction to debt is the same. Why? Because the illusion has only grown stronger and more complex. Modern economies aren't primarily driven by producing things anymore. They're driven by consuming things. But mass consumption relies on one fragile ingredient: confidence. As long as people believe the system is stable and their future is secure, they'll borrow, they'll spend, and they'll invest. But the moment that belief cracks, the entire engine freezes. That is precisely what happened in 1929, and that's the quiet fear that keeps economists up at night today. The real danger isn't just a market correction. It's what happens when trust evaporates. When people lose faith in the banks, in the currency, in the future itself, they stop participating. They hoard cash, they stop spending, they pull back from everything. And when everyone stops playing the game, the entire economic illusion risks falling apart. Let's dig deeper into the debt. In the years leading up to 1929, household debt in America was exploding. People were buying the latest cars, radios, and homes. Not because they had the cash, but because credit was easy and they believed their wages and the value of their assets would rise forever. Does that ring a bell? Now let's look at our world. Global debt has ballooned to over 300% of the world's total GDP. We're not just spending money we don't have. We're borrowing from the future just to maintain our lifestyles today. In the 1920s, banks sold risky loans, bundled up, and marketed as opportunities. Today, financial institutions sell incredibly complex derivatives and securities with the same reassuring smile, just with fancier, more confusing names. The financial instruments change, but the fundamental human psychology behind it all, it never does. We see corporate profits hitting record highs, while real wages for the average worker have barely budged in decades. The middle class is being squeezed from all sides by the rising costs of housing, education, and healthcare, forcing them to rely on debt just to maintain the illusion of stability. It's the same script, just being performed in a different century. So, who's in charge of managing all this? Let's look at the central banks. So what do? Do they keep printing money to prop up asset prices and risk runaway inflation? Or do they raise rates to fight inflation, knowing full well it could trigger a recession and crush the debt-laden system they helped create? It's a terrible choice with no easy answer. It's not just history rhyming, it's history repeating itself in slow motion, right before our eyes. And then, there's speculation. In 1929, people poured their life savings into stocks they barely understood. Why? Not because they'd analyzed the data, but because everyone else was doing it. Their neighbor was getting rich, their barber had a hot tip. It was a national fever. Does any of that sound familiar? Today, it's meme stocks, NFTs, crypto bubbles, new names for the same old, dangerous game. The human psychology driving it all hasn't changed one bit. It's still FOMO, a fear of missing out. It's still raw, unfiltered greed. And it's that eternal, seductive belief that this time is different. When prices are rocketing up, people feel like investing geniuses. But when the music stops and prices crash, they realize they weren't geniuses at all. They were just lucky. The Great Depression exposed an uncomfortable, timeless truth. When economic systems become too unequal, too leveraged, and far too overconfident, they inevitably collapse under their own weight. The question isn't if it will happen again, it's when. And if we're being honest with ourselves, most of the world Espanol economies today are running on little more than borrowed confidence and fumes. The warning signs are already flashing, just like they did back then. We see record levels of household debt, corporate defaults are quietly ticking up, and governments are printing money at a speed that defies belief, hoping to paper over the cracks. But there's one massive, terrifying difference between now and 1929. Back then, the global financial system was smaller, more fragmented. When it collapsed, it destroyed millions of lives. But the devastation was mostly contained within national borders. Today, everything is interconnected. A financial shock in one country doesn't stay there. It ripples across continents in seconds, a digital wildfire that can't be contained. This makes the stakes infinitely higher. Because what happened in 1929 wasn't just a financial failure. It was a failure of imagination. People genuinely believed that the prosperity of the Roaring '20s was permanent. They couldn't conceive of how fragile their entire system really was. And now, we're making the exact same mistake. We're placing our blind trust in central banks, politicians, and complex algorithms to keep the illusion of stability alive. But stability that's built on a mountain of debt and rampant speculation isn't real stability. It's just borrowed time. The most important lesson of 1929 wasn't truly learned. It was forgotten. Because every generation has the hubris to believe they're smarter than the last. But this time, they've engineered a safer, crash-proof system. But this time, will finally be different. But the historical patterns don't lie. The Great Depression began with just a few bad days on Wall Street, but it ended with a decade of global pain, deflation, and a complete loss of trust in the institutions that were supposed to protect people. The danger today isn't that history is simply repeating itself. The danger is that we are repeating history. And if the same economic forces of speculation, debt, and inequality are back in play, the real question isn't what if it happens again. The real question is, what happens when the illusion finally breaks? By the early 1930s, the illusion had completely shattered. The vibrant energy of the 20s was replaced by the grim reality of the 30s. Long lines of hungry citizens, desperate for a piece of bread, stretched for entire city blocks. Banks, once seen as pillars of the community, failed by the thousands, wiping out the savings of ordinary families overnight. People lost their homes, their jobs, their savings, and worst of all, their hope. What began as a financial panic on Wall Street had metastasized into a full-blown social collapse on Main Street. Governments scrambled to respond, but their tools were blunt and often made things worse. In a desperate attempt to show fiscal discipline, they slashed spending to balance budgets, which only threw more people out of work. They raised tariffs to protect domestic industries. But this just choked off international trade and triggered a wave of retaliation. Every move they made, intended to fix the problem, seemed to deepen the wound. Unemployment skyrocketed to levels we can barely imagine today. Global trade froze solid, and confidence, the invisible glue holding the entire economic system together, completely disintegrated. In their fear of short-term chaos, policymakers accidentally guaranteed a long-term collapse. The Great Depression didn't last for a few months. It lasted for an entire decade. It was a deep, festering wound that fundamentally reshaped politics, economics, and people's faith in the very idea of capitalism. But here's the uncomfortable truth. The same flawed logic is clearly visible today. Every time cracks appear in the global financial system, policymakers reach for the same old, tired tools. They print more money. They cut interest rates to near zero. They bail out failing institutions and promise the public that everything is under control. But they are only treating the symptoms, not the underlying disease. The global economy now floats on an ocean of debt that can never, ever be truly repaid. It's a system held together by constant central bank intervention and, most importantly, by public belief. And belief is fragile. Because when that faith finally breaks, history doesn't just repeat itself. It rhymes. Now, let's talk about leverage, the invisible accelerant, the financial gasoline poured on every fire. In the 1920s, ordinary investors could borrow up to 90% of a stock's value. It was called buying on margin. This meant that when stock prices dipped even a little, their brokers would call in the loans. These margin calls triggered a cascade of forced sales. Forced sales pushed prices down further, which triggered even more margin calls and more panic. It became a catastrophic downward spiral that no one could stop. Today, that same dangerous leverage still exists, but it's much better hidden. It's no longer as simple as an investor borrowing from a broker. Now it's buried deep inside the complex machinery of global finance within massive hedge funds, in opaque derivatives markets worth trillions, and in the sprawling, unregulated world of shadow banking. It is disguised in sophisticated trading algorithms and complex financial products that even the regulators admit they do fully understand. The mechanisms have evolved, becoming more complex and harder to track, but the core danger hasn't changed one bit. There's too much risk, too little transparency, and way too much confidence in financial models that are built on a fragile set of assumptions. What really caused the Great Depression? It wasn't just a stock market crash. It was a crisis of belief, a collapse of trust, first in the markets, then in the institutions people thought were safe. In the 1930s, banks closed overnight. People's life savings vanished in an instant. The government's answer was the FDIC, a promise to restore faith. And for a while, it seemed to work. But today's world is a different beast entirely. Banking isn't local, it's global. Money moves not by hand, but at the speed of light. Remember when Silicon Valley Bank failed in 2023? Panic didn't just spread through California. It leaped across oceans in seconds. Investors froze. Confidence evaporated. The very same fear that haunted 1929, that invisible dread of your security disappearing without warning, it is still here, lurking just beneath the surface. What made the Great Depression so devastating wasn't just the financial loss. It was psychological. People didn't just lose their money. They lost their belief in the system itself. Their belief in progress, in control. In the very idea that prosperity was a permanent fixture of modern life. That belief had become a kind of religion, and when it shattered, everything broke with it. The danger we face today is eerily similar. For decades we've been told a comforting story. The system is under control. Central banks can manage the economy. Policymakers can smooth out the rough patches. Recessions are just relics of a primitive past. But look at the fine print. Every fix requires more debt. Every bailout demands more intervention. And every intervention distorts the system a little more, pushing it further from reality. Each solution we apply today plants the seeds for an even bigger collapse tomorrow. You can manipulate interest rates, you can flood the system with liquidity, but there's one thing you can't control: belief. And once that cracks, no amount of policy, no reassuring speech, can hold the illusion together. The Great Depression wasn't just an American tragedy, it was the world's rude awakening. Because when Wall Street imploded, Europe didn't just watch from the sidelines, it fell. Banks went under, currencies failed, governments panicked. Germany, already crushed under war debt, was pushed into absolute chaos. But here's the detail most people miss. The Depression didn't just reveal economic failure, it exposed just how interconnected the world had become. A fragile chain of dominoes stretching across the globe. When one fell, the rest were sure to follow. And here's the truly scary part. That exact same structure exists today. Only it's 100 times bigger and infinitely more complex. Back then, the entire global economy was a fraction of what it is now. Today, global debt is over $300 trillion. So when one major nation defaults, when one key currency devalues, or when one too-big-to-fail bank finally does ... the damage doesn't stay local. It spreads like a digital virus, infecting the entire global financial system in minutes. The architecture is larger, but it's no sturdier. In 1929, policymakers thought they could fix the crisis with optimism. They held press conferences, gave confident speeches, and made small, symbolic interventions. They fundamentally misdiagnosed the disease. The problem wasn't a temporary panic, it was a systemic crisis of leverage. People weren't acting irrationally. They were overexposed and waking up to the danger. Sound familiar? Because right now, we're making the same mistake. Central banks are flooding the markets with liquidity, operating under the assumption that more money equals more stability. But liquidity is not solvency. You can print all the money in the world, but you can't print real value. You can delay the recognition of losses, but you cannot erase them. And the longer you delay the inevitable, the more violent the eventual correction becomes. History shows us this again and again. Every financial bubble has its own slogan. In the 1920s, the magic words were, "This time is different." People truly believed it. They said new technology, new management styles, and new government policies meant the old rules of economics no longer applied. But they did. They always do. Now, fast forward to today, what are investors saying? The exact same thing. AI changes everything. Tech stocks will grow forever. But if you look closer, the picture isn't so rosy. Companies are burning through billions of dollars in cash, yet they're trading at record-high valuations that have completely detached from reality, and somehow, everyone is convinced it's fine. The names on the ticker have changed. RCA has become Tesla. Bethlehem Steel is now your favorite unprofitable startup, but the psychology driving it all, it's identical. Debt bubbles don't care about innovation or exciting new narratives. They only care about one thing: math. And math doesn't lie. The formula is simple and brutal. If debt grows faster than income, the system eventually breaks. If economic growth depends on an endless supply of cheap credit, it will inevitably collapse. It might not happen today, and it might not happen tomorrow, but arithmetic always catches up. We are repeating the exact same structural flaws that doomed the 1920s. Let's talk about something no one wants to talk about: inequality. Before the Great Depression, the wealth gap was a chasm. The rich were speculating, throwing money at the stock market like it was a game. The poor, they were borrowing just to get by. When the crash hit in 1929, the poor lost everything they didn't really have in the first place. Now take a look around. Does any of this sound familiar? It's like we're watching a rerun of history, but this time it's in ultra-high definition. Today, the top 1% own more than half of the entire world's wealth. Their assets are growing at a speed that most people's paychecks can only dream of. And when things like house prices go up, the middle class feels a little richer, right? But here's the hard truth. That's not real wealth. That's leverage. It's borrowed money masquerading as prosperity. And what happens when the music stops? When interest rates start to climb? That illusion shatters into a million pieces. This is the point where societies start to fracture. It's when anger boils over. Populism, protectionism, wild conspiracy theories, they all grow from the same bitter soil. Economic pain. Back then, people blamed foreigners. They blamed the bankers. They blamed the whole system. Sound familiar? It's happening again? You hear it everywhere. History doesn't repeat itself, they say, but it sure does rhyme. And what about the people in charge? Back in the 30s, governments tried austerity. They slashed spending, thinking it would restore confidence in the economy. It was a catastrophic failure. Today they're doing the exact opposite. They're printing money like there's no tomorrow, just to keep the system from collapsing. But here's the secret. Both of these roads end in ruins. One leads to a slow, painful death from deflation and despair. The other is a fast, fiery crash of inflation and decay. The real truth is that sustainable prosperity requires balance. It's not that complicated. Debt should be used to build real, productive things, not to fuel wild speculation. Economic policy should aim for long-term stability, not short-term popularity. But here's the problem. Politicians don't get re-elected for being patient. They get rewarded for quick, visible results, even if those results are built on a house of cards. So, the cycle just keeps going. And when it finally breaks, just like it did in 1929, you know what everyone will say? Nobody saw it coming. In 1929, speculation was something you could see. You could walk down Wall Street and see the crowds huddled outside brokerage houses, their eyes glued to the ticker tape, their hearts pounding with every little uptick. It was tangible. But today, speculation is invisible. It hides behind our screens. It's digital, instantaneous, algorithmic trades, complex derivatives stacked on top of more derivative zips, layers upon layers of leverage, moving at the speed of light. And that speed, that's not progress. It's fragility disguised as efficiency. Because when sentiment turns, and believe me, it always turns, there is zero time to react. The markets today move faster than a human brain can even process. By the time you realize what's actually happening, it's already over. That's the real danger of our modern financial world. Velocity without understanding. And that's precisely why the next crash, whenever it comes, won't be a slow burn. It won't spread gradually. It will detonate before most people even realize the fuse was lit. But the most dangerous parallel between then and now isn't economic. It's psychological. Think about it. Right before every major collapse in history, people feel their sickest. They put their faith in technology, in the idea of endless progress, in their belief that they are in complete control. They convince themselves, with absolute certainty, that this time is different. And if anyone dares to warn them, what happens? They're laughed at. They're dismissed. In the 1920s, the investors who sold their stocks early were mocked as fools who were missing out on the party. Fast forward to today, and anyone who even mentions the word bubble gets labeled a doomsayer, a pessimist who just doesn't get it. But here's the thing about overconfidence. It blinds you. Complacency builds up slowly, day by day, until the whole system is resting on a knife's edge. And then, one day, something breaks. It could be anything. A major company defaults on its debt. A government bond auction fails. A sudden, unexpected freeze in liquidity. And in that instant, the entire illusion evaporates. The magic trick is over. But here's the good news. History is not destiny, it's a teacher. The lessons are all there, sitting in plain sight, waiting for those of us who care enough to listen. So what can we do? Diversify your risk. Don't put all your eggs in one basket, especially a basket that everyone else says is a sure thing. Question the consensus. When everyone is shouting the same thing, that's usually the time to be most skeptical. And remember this fundamental truth. The value of anything, from a stock to a currency, depends on trust, and trust depends on discipline. Markets don't fail just because prices fall. That's normal. They fail when people forget why prices went up in the first place. In 1929, nobody could imagine a decade of global despair was just around the corner. Have you ever wondered if we're really any smarter than our ancestors? Or are we just repeating their biggest mistakes with faster Wi-Fi? Let's talk about 1929. The Great Crash wasn't just about stocks tanking. It was a complete meltdown of faith. Faith in the markets, faith in the leaders, and faith in the promise that if you just worked hard, everything would be okay. That collapse was a wake-up call. It forced the world to rewrite the rules. In America, we got the New Deal, things like bank deposit insurance, new regulations, and social safety nets. Now these didn't magically end the Great Depression overnight, but they stopped the free fall. They introduced a radical new idea. The government would now step in to guarantee economic stability. But here's the catch. Once governments got a taste of that power, the power to tweak and manipulate markets for the sake of stability, they never really let it go. Fast forward to today. What happens when the market panics? Central banks fire up the money printers? When the economy slows down, the government starts spending. We've created a system where investors almost expect a bailout. The risk is shared by everyone, but the rewards, they stay private. Back in 1929, that idea would have been insane. Today, it's just business as usual. And that's how history creeps up on you. What starts as a one-time emergency fix slowly becomes standard procedure. Before you know it, what we called stability is actually an addiction. The Great Depression burned one lesson into the minds of every economist. Deflation is the ultimate killer. When prices fall consistently, people stop spending and start hoarding cash. Why? By today, what will be cheaper tomorrow? When people hoard cash, businesses stop investing, and when they stop investing, the whole economy grinds to a halt. So, modern leaders decided to flip the script. They thought, okay, we'll accept a little bit of inflation instead. It's the lesser of two evils. But that little bit of inflation isn't free. It's a hidden tax. It quietly erodes the value of your savings. It rewards people who take on debt and punishes those who are careful with their money. It's a slow, silent transfer of wealth from the worker to the asset owner, from the cautious to the reckless. And once an economy gets hooked on that easy fix, it can never truly allow prices to fall back to normal again. That's why every single financial crisis we see today ends the same way, with a massive bailout, not with a necessary bankruptcy. We save the system, but we keep the underlying problems. Think about the scale of things. Back in 1929, the financial system was mostly national. If one country had a problem, it might spread, but it took time. Today our system is planetary. Capital zips across the globe in milliseconds. Complex financial products tie banks together from continent to continent. A single policy mistake made in Washington can cause chaos in Frankfurt, Beijing, and Sao Paulo within minutes. The very interconnectedness that was built to create global prosperity now acts as a massive risk amplifier. When one small part of the system breaks, the contagion isn't slow and steady, it's instantaneous. It's why even small economic shocks feel like global earthquakes. The entire structure is designed to magnify every single tremor. The Great Depression didn't just wreck economies. It redrew the map of global power. Economic hardship fueled nationalism, protectionism, and eventually, conflict. People were desperate for a way out, for some sense of order. So they turned to strongmen who promised simple solutions and absolute certainty. And if that sounds a little too familiar right now, well, it should. We're seeing the same psychology play out again. When people feel economically insecure, political extremism starts to look attractive. Populism, outrageous trust in institutions, evaporates. The foundations of democracy begin to weaken. When people feel the system is rigged, they stop looking for the truth and start looking for a leader who promises to take control, no matter the cost. In the 1930s, that mindset led to the rise of fascism. Today, it's giving us something a bit more subtle, but just as dangerous. Masked manipulation disguised as comfort and control. The 1929 crash was triggered by a blind faith that markets would always correct themselves. Today our blind faith is that governments can always save us. But here's the uncomfortable truth. Both of these are illusions. Back in 1929, if you told a farmer in Kansas that his entire livelihood was tied to a bunch of slick-haired guys trading paper on Wall Street, he'd probably laugh you out of town. He didn't see the connection between their complex games of leverage and the price of his wheat. But when that credit, that invisible lifeblood, suddenly froze solid, his entire world came crashing down. He learned the hard way that everything is connected. Fast forward to today. You might think we're smarter, that we've learned our lesson. But the truth is, the connections are now 1,000 times more complex and 1,000,000 times faster. But they are just as real. When a central bank halfway across the world decides to tweak an interest rate, what happens? Your mortgage payment shoots up. Suddenly, buying a house becomes a distant dream for millions. When the housing market cools, construction jobs disappear. When those jobs vanish, local businesses, from the corner cafe to the family-owned hardware store, start to struggle. It's a vicious feedback loop, and it spins faster than ever before. And who's at the end of that chain reaction? It's not some abstract algorithm or a line of code on a server farm. It's real people. It's you. It's me. It's our neighbors. The technology has changed the scale of the game, but it hasn't changed the fundamental nature of it. The human cost remains the same. Think about the Roaring '20s. Back then, information traveled at the speed of a ticker tape machine, printing out stock prices with a significant delay. There was time, however brief, for human judgment, for a moment of pause. Today, algorithms trade at the literal speed of light. They operate in microseconds, executing millions of trades before you can even blink. But these algorithms, for all their speed and efficiency, lack something crucial. They have no judgment, no patience, and absolutely no fear. And that is precisely what makes modern financial crises so much more violent and unpredictable. When these machines detect a downward trend, a slight dip in the market, they don't hesitate. They don't weigh the consequences or consider the bigger picture. Their programming is simple: sell. And when a tidal wave of automated selling hits the market, it triggers other algorithms to do the same. A small ripple becomes a tsunami. Liquidity, the ability to buy or sell assets easily, evaporates in seconds. What once took weeks of panic and deliberation during the Great Depression now happens in the pre-market hours, before most of us have even had our morning coffee. The cycle of boom and bust has been compressed into a terrifyingly short time frame. But the consequences, the lost homes, the shattered savings, the broken dreams, they haven't changed at all. They've just become more immediate. But here's the crucial part of the story that most people forget when they talk about the Great Depression. It wasn't just a story of destruction, it was a story of forced reinvention. Out of the smoldering ruins of the global economy came profound reform. The Social Security, the FDI, these pillars of our modern financial system, were born from the ashes of that collapse. Out of widespread despair came a surge of innovation and a reevaluation of what society owed its citizens. True resilience isn't born from comfort and stability, it's forged in the fires of crisis. And that brings us to the real challenge we face today. Our challenge isn't just to survive the next collapse, but to adapt before it happens. We don't have the excuse of ignorance that people in the 1920s had. We know the warning signs because we've seen them before. Unsustainable levels of public and private debt. Check. Asset bubbles, from stocks to real estate, inflated to dizzying heights. Check. Growing inequality that hollows out the middle class and fuels social unrest. Check. A blind, almost religious overconfidence in our ability to manage it all? A big, fat check. We even know the tools to fix it. Fiscal prudence. Investing in productive parts of the economy instead of speculation, and policies that promote shared prosperity. So, what's missing? The will, the political and social courage to act. It's always easier to kick the can down the road. It's easier to borrow another $1 trillion. It's easier for central banks to print another rescue package. It's easier to postpone the pain just for a little while longer. But every single postponement, every bailout, every quantitative easing, it doesn't solve the underlying problem. It just compounds the final reckoning, making the eventual crash even more severe. If you study the historical records from 1929, one word echoes through the decades: denial. In the weeks leading up to Black Tuesday, journalists dismissed the initial market drops as healthy corrections. Prominent politicians assured the public it was just temporary turbulence. The most powerful bankers in the world swore on their reputations that the fundamentals are sound. By the time they were forced to admit the horrifying truth, the entire system had already fractured beyond repair. That denial, that stubborn refusal to believe what the evidence is screaming at you, is timeless. It's not a relic of history. It's all around us right now. We see it every day. The markets are euphoric, hitting all-time highs while the real economy struggles. Valuations for some companies defy any form of logic or gravity. And through it all, the heads of our central banks stand before the cameras and assure us, with unwavering confidence, that they have everything under control. But beneath this calm surface, the strain is building. The pressure is mounting, quietly, just like it did in 1929, and I can't help but wonder. When future historians study our time, will they ask the same haunting question we ask of the 1920s generation? How on earth did they not see it coming? And the answer, I fear, will be exactly the same. They did see it. They just chose not to believe it. Because facing a difficult truth is hard, correction is painful, and comfort is always the easier path. That is the core, brutal lesson of every single financial crash in history.